Welcome to our new video on diversification. Today we will learn the valuable strategy of diversification that can help you invest safely and develop immense wealth. To start, what is diversification? Diversification just means to spread out your budget over a wide variety of investments, industries, and other categories. Diversifying into both airliners and railroad companies would not be as helpful, as the two industries are similar and therefore strongly linked. However, stocks in airliners such as Delta and competing companies such as Intel would react differently to a worldwide pandemic like the coronavirus. You can invest into both to maintain a well-diverse portfolio. What are some benefits of diversification? By diversifying, you minimize your risk to any economic change or event. Diversification into tens, even hundreds of different smaller investments can minimize your risk to the variance that any one stock may have. With a well-diverse portfolio, a major change in a single industry will not have an enormous effect on your money. For example, if one company makes a major mistake and drops by 50%, but you only invested 10% of your budget into them, then your net loss is only 5%. Examples of this are the index funds such as the S&P 500 and the Dow. These funds are composed of hundreds of different stocks, and so they serve as an indicator of the general market as a whole. While a single company could suddenly go bankrupt after making a series of bad decisions, the market as a whole tends to grow over time, and so these well-diversified indexes also tend to grow slowly but surely. During the COVID-19 pandemic, those with diversified portfolios received better benefits from their investment compared to someone concentrated in travel stocks. Stocks in the travel sector, dealing with airfare, hotels, and etc., experienced collapses, while technology and stocks like Moderna grew significantly. Diversification would increase your portfolio's exposure to all types of stock and minimize the loss you take from these crashes. To diversify your investment portfolio, begin by buying many types of assets. Whether it is stocks, real estate, tangible assets, having different kinds of assets is a great way to diversify. In these assets, you can diversify your portfolio as well. For example, in real estate, you can buy different types of properties in locations around the world, or in stocks, you can invest into different sectors. Outsourcing your investment portfolio will accomplish this to a certain level. You can also buy exchange-traded funds, also known as ETFs. ETFs are, practically, a bundle of stocks that can be diversified, which are simple to buy. Finally, although diversification is great, there are some drawbacks. In horrible crashes like the 2008 crash, diversification would not have helped in minimizing losses and keeping a safe portfolio. Furthermore, as diversification makes your portfolio less risky, there's also a less chance of a random, unlikely high swing that makes you rich very quickly. Generally, it is good to avoid hindsight bias when investing and diversifying because of this. Thank you for watching our video on diversification. I hope you can apply this knowledge to further your career and become more successful.